So let's get right into it. When we look ahead to 2026, the economic picture is anything but simple. It's not just a straightforward story of growth or recession. What we're actually seeing is a complex tug of war with incredibly powerful and often opposite forces pulling the global economy in completely different directions, all at the same time. And that right there is the big question we're going to unpack today. Because if you want to understand what's coming next, you absolutely have to get a handle on these conflicting trends. JP Morgan has the perfect phrase for this. They call it a multidimensional polarization. And that just nails it, doesn't it? It captures this idea that we're not just looking at one single trend, but a head-on collision of several massive shifts happening across markets, technology, and even geopolitics. So what's actually stirring the pot here? Well, the analysis really points to three main drivers that are set to define the year ahead, and they're creating this wild environment of both unbelievable opportunity and some pretty significant risk. Here they are, the three big colliding forces. First, you've got central banks all over the world doing different things with their monetary policy. It's totally uneven. Then you have the AI supercycle, which is just steamrolling ahead and reshaping everything in its path. And finally, there's this deepening polarization happening within the markets themselves, which is really being fueled by all the geopolitical fragmentation we're seeing. It's how these three forces smash into each other that's going to be so interesting. And just before we go any further, please remember to subscribe to our channel and turn on the notification bell, share and like our videos. This is not investment advice. The information in the video is compiled from open sources. Thank you. Okay, first up, the relentless expansion of AI. Look, this is so much more than just a tech trend. Analysts see this as a fundamental economic engine, one of the primary forces that's going to be driving growth and market dynamics in 2026. And if you want to put a number on it, check this out. JP Morgan is estimating that the AI supercycle alone will drive S&P 500 earnings growth by 13 to 15%. That is a massive tailwind for the stock market, and it just shows how deeply AI is already baked into corporate profits. But the shockwaves from AI go way beyond Wall Street. It's kicking off a legitimate infrastructure boom. I mean, the sheer amount of energy and computing power these AI models need is causing a massive surge in demand for data centers. JLL points to this as a key force that's completely reshaping the commercial real estate game. Now, here's where it gets really fascinating. This boom creates something called price-inelastic demand for certain materials. Think about it. Sectors like AI and green energy absolutely need commodities like silver to function. For them, the cost of silver is a tiny part of their total budget, but it's essential. The bottom line is, running out is simply not an option, so they'll pay almost anything to get their hands on it. And this idea leads us directly to one of the most dramatic examples of polarization in the entire market: commodities. I mean, we are seeing two completely opposite stories playing out, creating this huge divide between energy on one side and metals on the other. So on one side of the divide, you've got oil. And as Natasha Kanavova over at JP Morgan puts it so well, the issue isn't demand. The problem is a flat-out flood of supply, especially from countries outside of OPEC. This is creating a really significant surplus in the market. The results? A pretty bearish forecast for oil. JP Morgan sees Brent crude averaging just $58 a barrel in 2026. And the World Bank seems to agree, forecasting that commodity prices overall could hit a 6-year low, mostly because of this growing oil glut. But wait, that's only half the story. Because on the other side of this great divide, the outlook for metals is incredibly bullish. Demand here is being absolutely supercharged by the green energy transition, the needs of AI, and a huge surge in people looking for a safe place to put their money. So let's dig into that safe haven demand, because it's a huge piece of the puzzle. In a world that feels increasingly uncertain, we're seeing both central banks and regular investors just flocking to precious metals like gold and silver as a way to protect their wealth. So what's causing this rush to safety? Well, it's basically a perfect storm. You've got central banks actively moving away from the US dollar. You have geopolitical tensions creating all kinds of uncertainty. There are real concerns about US debt levels. And to top it all off, the expectation of rate cuts, which is part of that uneven monetary policy we mentioned, makes something like gold, which doesn't pay interest, look a whole lot more attractive. Now take a look at this chart, because it really visualizes a fundamental shift in how central banks are behaving. Before 2022, they were buying, on average, about 450 tons of gold a year. For 2026, JP Morgan is forecasting that number to be 755 tons. This isn't just a temporary blip. It represents a new, much higher level of demand that's putting a solid floor under the gold market. And the experts think this trend has plenty of room to run. Gregory Shearer at JP Morgan says that the structural buying from central banks, combined with all the investor demand, gives them strong conviction that gold prices are headed way, way higher. And this conviction leads to a truly staggering forecast. JP Morgan has put a price target on gold of $5,000 an ounce by the end of 2026. And they're not alone in this. Other major institutions are seeing a similar path, pointing to all that geopolitical risk and supportive central bank policy. And silver's story is just as powerful. It's getting a double boost. First, from that price-inelastic industrial demand from AI and green tech we talked about, and second, from its role as a monetary metal. Put it all together, and JP Morgan is forecasting silver to hit $58 an ounce by the end of 2026. All right, let's pivot to our final major theme, real estate. This is another sector that's experiencing its own kind of polarization. After a really tough couple of years, the whole outlook is shifting from just surviving to actually being optimistic, and we're seeing clear signs of a rebound driven by some very specific trends. Yeah, the whole feeling around real estate is just getting better. With inflation cooling down and the real possibility of lower interest rates on the horizon, we're starting to see capital flow back into the property market. And this is a direct result of that shifting monetary policy we talked about at the very beginning. JLL has identified 3 key forces that are really driving this rebound. First, higher operating costs are forcing everyone to get laser-focused on efficiency. Second, because there hasn't been a lot of new construction, there's now a shortage of top-quality spaces, which is heating up competition. And third, the whole idea of experience, creating these amazing, personalized environments, has become the new make-or-break factor for the best properties. So when you pull all these different threads together, the picture for 2026 starts to make a lot more sense. It really is a story of deep polarization, where everything is interconnected. You have this AI-driven tech boom happening at the same time as geopolitical fragmentation. You've got a bear market in oil right alongside a historic bull market in precious metals, and a real estate sector that's bouncing back, but based on totally new rules around efficiency and experience. Which really leaves us with one final big question. In this new world of colliding forces, of tech disruption, energy transition, and geopolitical shifts, it's not about one single trend anymore. The real question for 2026 and beyond is, which one of these powerful, polarized trends will win out and ultimately define the era to come?